Understanding the financial crisis of the United States. What does $38 trillion in debt mean for you? How the U.S. government plans to manage unpayable debt. Discover the hidden dangers of national debt. Is your savings at risk due to government debt? Unveiling the truth behind monetary policy changes. Section 1. Overview of the national debt crisis. On October 23, 2025, the national debt of the United States exceeded $38 trillion, marking a significant milestone in financial history. This staggering amount is double the economic output of the entire European Union and represents a burden of $500,000 for each American under 18 years old. Section 2. Current debt accumulation trends. The debt is accumulating rapidly, with the Congressional Budget Office reporting an increase of $69,713.82 per second over the past year. This acceleration reflects a troubling trend, as the U.S. is projected to reach $40 trillion in debt by 2027. Section 3. Interest payments and budget implications. Interest payments on the national debt are the fastest growing part of government spending, costing over $1 trillion in fiscal year 2025. This excessive spending leaves little room for funding essential services, as nearly $1 out of every $5 in tax revenue goes solely toward interest payments. Section 4. The dangerous debt spiral. The average interest rate on the national debt has risen from 1.58% to 3.38% in 5 years. Higher interest rates increase the cost of borrowing, forcing the government into a cycle of more debt to cover interest payments. This debt spiral could become unsustainable during an economic downturn, leading to more severe fiscal problems. Section 5. Debt monetization explained. The government has a strategy known as debt monetization, where the Federal Reserve creates new money to purchase government bonds. This process allows the government to gain necessary funds without directly raising taxes or cutting spending. However, this dilutes the value of existing currency, impacting the purchasing power of every dollar in circulation. Section 6. Impact on your savings. When the Federal Reserve buys government debt, it leads to inflation, diminishing the value of savings and investments. The strategy, while appearing to manage debt, essentially transfers wealth from savers to those in debt by reducing the value of the currency. Section 7. The role of asset revaluation. The government is considering strategic asset valuation changes for resources like Bitcoin and gold. By changing how these assets are valued, the government could artificially inflate its balance sheet, making its financial situation appear stronger while continuing practices that devalue currency. Section 8. Global economic ramifications. Countries around the world are noticing these trends and moving away from dollar reserves. As they abandon the dollar, the demand for it will diminish, leading to further depreciation in its value. This international shift could destabilize the U.S. economy further. Section 9. Conclusion and awareness. The current economic policies signal a major shift in how debt is handled in the U.S. Without public awareness or understanding, everyday Americans could find their savings and purchasing power significantly reduced. It is crucial to stay informed about these financial strategies and their potential impact on personal wealth.